Individual investors, institutions, portfolio managers, and central banks are increasingly turning to gold to diversify portfolios, protect against inflation, and safeguard wealth. Yet in the current financial climate, and with a growing variety of choices for investors looking to purchase gold, a word of advice is necessary.
Not all gold investments are created equal.
In an attempt to safeguard wealth, investors may unwittingly purchase a fractional-based investment, a gold price tracking vehicle, or simply a liability of the issuer. In the early 1960s, a fraud was perpetrated in the UK. A promoter offered investors an opportunity to own a sow for future consumption. The value proposition was simple. A city dweller could own a sow without owning a farm. As evidence of ownership, an investor received a certificate with a serial number, and the same number was imprinted on a tag and clipped in the sow's ear. For a few years, the sow scheme ran smoothly. Until one day, an accountant decided to visit the farm to ensure the sows existed. Upon arriving at the farm, he saw the sows, but to his horror, he also saw that 10 different tags were on each sow's ear. Each sow had been sold 20 times. This story highlights important considerations when purchasing physical assets such as gold. Investors must ensure the following. The bullion exists. There is clear title to the bullion. The investor is the only owner of the bullion, and title is passed to the investor. Remarkably, investors perform such prudent and rational steps when purchasing homes, land, automobiles, and boats, yet these precautions are not taken when buying assets such as gold. Just as the accountant discovered each investor only owned 1/20th of a sow, investors with a portfolio allocation to gold may discover otherwise. The gold they think they own may merely be partially backed by gold, may be leased to third parties, or backed by unsecured promises. As a first step to owning gold, investors must decide they want to either trade gold or hold gold for wealth preservation. With this in mind, the following are key questions. Are precious metals a short-term speculation, or will the metal be used to preserve wealth over the long term? Is the purpose of the purchase to fully diversify a portfolio? Is protecting wealth from a financial crisis a fundamental motivation? Does the investor want to own a physical bullion or a paper proxy for bullion? The precious metals pyramid illustrates various ways to purchase gold. At the top are the riskiest and most illiquid purchases. Further down the pyramid, safety and liquidity increase, with physical bullion stored on an allocated basis being the safest and most liquid choice. There is no substitute for physical bullion purchased outright and held on an allocated basis. For investors who don't care about owning bullion and simply want to track the price of gold for trading purposes, then futures contracts, options, certificates, pooled accounts, exchange-traded funds, or mining stocks are available. Yet these investors lose the advantages offered by precious metals ownership. Owning precious metals works like insurance. Just like we buy insurance policies for our homes, cars, and boats, owning precious metals ensures our portfolios remain protected. Investors must exercise caution when choosing what type of bullion to own. Obtaining wealth preservation and portfolio protection through the safe haven attributes of gold, silver, and platinum is a smart decision. Physical bullion with allocated storage ensures precious metals are in place when needed most.